Mark Andersen, co-head of Global Asset Allocation at UBS, joining us now. UBS Global Wealth Management. Mark, let's just talk a little bit about this. You've got a move that's accelerating to the upside. At the moment, equities are taking it pretty calmly. But you've got a payroll number Friday that could be really, really strong and could further propel yields even higher. At what point do investors need to start thinking that this could have a meaningful impact on their portfolios?
Well, I think it's certainly already having a meaningful impact for the fixed income oriented investors. And if anything, we're expecting these yields to move higher towards a 2% rate towards the end of the year. And I think what's really driving it is, as we see it so far, it's certainly the inflation expectations. And it's on the back of not only the 1.9 trillion fiscal stimulus package that was announced earlier this year, but also the looking forward to this 3 trillion stimulus package that is in talks now in terms of infrastructure from the US. So these things combined basically means that there's upward pressure on yields. When we analyze the consequences for the equity markets, we really find that equity markets has a very positive correlation to not only inflation expectations, but also the kind of growth rates that we're expecting to see this year. So there's only really been a mild overshoot on the yield side to be a little bit of a drag on equity markets, but we think, frankly speaking, it's rather limited.
But I guess, Mark, my question is, how do you play the reflation theme when it's asynchronized, but the bond market reaction is synchronized?
That's exactly the way we have to think about it. I think that's the right framing. And what we're doing is obviously we've been standing kind of, when we look about the equity rally overall, it's basically standing on the three pillars of kind of the reopening trade, and we got fiscal and we got monetary stimulus. So this equation has not really changed significantly in the last couple of quarters. But what it means is obviously then when we have the last asset class to kind of reprice back to some degree of normal, which is the fixed income market, you're just going to have equity sectors that are going to perform better on the back of this. So we like financials, energy, emerging markets, small cap trades, a lot of these kind of very cyclical reflationary trades that, if anything, like you're seeing financials being up today, more the tech are being hurt, even despite some of the stories we're having out over the last couple of days. So it means we have to be a bit more careful how we position, in particularly on the equity markets. What
about Europe? Okay, look at the CAC. The CAC 40 is up by 9.6, 9.7% quarter to date. The DAX is up by 9.43%. The Italian market is up by 11% this quarter. Given what's happening in Europe, does that seem right to you? Or is Europe just kind of dominated by the kind of value stocks that the market loves right now? And if so, can it continue to stay in love with those kinds of names?
I think that's exactly the story. So if we look at the vaccine story or any sort of global or European growth recovery over this past quarter, that's not something to get very enthusiastic about. But I think you're absolutely right. What has been hurting kind of European stocks for the entire past decade essentially has been that the technology sector is really not present on the European front if we compare to, say, US or Chinese equity market. But now all of a sudden, these are all the stocks that we want to own these days. So it's value, it's very cheap. If you look at the financial sector, which is trading at a kind of 2 standard deviation cheap to kind of even the normal discount that we're seeing relative to the broad market. It's even both in US and Europe. You have a lot of these great cyclical drivers like falling non-performing loans. You have very high capital ratios, so banks are very well capitalized. If anything, we're going to see some stock purchase programs, maybe outside of some of the few names that I mentioned on your show these days, but on a broad spectrum, there's just a lot of attractive valuation. Europe has been struggling, is falling behind, but Europe has also been the most closed down. So it means that once we finally get these vaccines to be rolling out now in the second quarter, we expect 40% of the population in Europe to have had the first shot in the arm by the end of the second quarter. And what it means is that pop in Europe on a growth front is going to get even stronger than elsewhere.
All right, well, let's just pretend that plays out. How long is that trade for?
So obviously, a lot of this comes back to that valuation equation. So how much of a discount do we still want to put on some of these fundamental trades? And if we kind of look at it, we're probably halfway there in terms of some of the value stocks having caught up. So we do think it can run a little bit longer. Whether that's a quarter, that's another 2. That depends a lot on how quickly this kind of market is replaying or playing into that growth story in Europe and the reopening trade there. So we'll have to monitor to that as we go along.
If you're a US investor versus a Euro investor, the DAX has done 9.5%. If you're a Euro investor, it's done 5%. If you are a US investor, a dollar-denominated investor. What is your expectation? What are you telling clients in terms of how they want to currency hedge their portfolio? How much dollar risk do you think there is within those portfolios?
No, absolutely. I think if you look at that comparison year to date, you might get the sense that Europe has already done extremely well. But if we take a further step back and we say from January 2020, if you've been buying particularly some of the larger cap US names, you'd be up 20-30% compared to the beginning of 2020. And on your European stocks, you're going to be flat. So there's even just a bit of catch up that I think is still happening here. Then on the currency front, I think you bring in probably the hottest debate at the moment here on our side, which is that we've been calling for dollar weakness for longer. But all of a sudden, we have what could be a little bit of a replay of that dollar strength story for some years ago. We have attractive yield differential. That's certainly one of them. On the other hand side, we also have a US growth sensation almost at the moment. So with these things combined, why wouldn't the US dollar strengthen? And we think there's a couple of reasons why you would still expect weakness. First of all, it's still an expensive currency. There's an extraordinary amount of debt that's being piled up, and it's really inflation that's keeping yields higher. So we are telling our US investors to move out of some of that US dollar exposure, look for the foreign exposure, even without kind of hedging some of those positions.
But you can make the argument too that even if Europe's going to play catch up because eventually people will get vaccinated, et cetera, and the reopening will be huge, I mean, the amount of money that the U.S. is pumping into the economy was also going to make that recovery that much more strong versus, say, the 750 billion euros from the European Recovery Fund.
That's absolutely true. But if we then, on the other hand side, if we look at valuation kind of on a broad S&P 500 index that is close to kind of a 30 times when we look kind of at the tech stock sectors in particular. So you're trading at a very expensive valuation. When we look at the fiscal stimulus, I think that's certainly a very, very powerful statement for a lot of the very domestic oriented companies. So it's certainly going to give us an earnings boost in the US. But typically what we see as well is that a lot of the growth impulse that's coming from the US, and typically US is the first kind of major developed economy to come out of a crisis. And it just has a fantastic spillover to other regions as well, as the export market is going to be picking up, which we're seeing in particular in Asia these days as well, where we're seeing great investment opportunities. So yes, it is a beneficiary to some of the very domestic oriented plays in the US. But globally speaking, I think there's more bang for your buck if we look in places like, in particular, emerging markets, China also.
Mark, when I look at these markets, and let's come back to Europe, I sometimes worry that people are confusing value and cyclicality. Do you think there's a danger that overlap is too great?
No, I think there is certainly a point to be made that this is not necessarily the same thing that you're investing into, even if you're right, there is certainly a deeper overlap here. On the cyclical side, I think the reason that we are quite keen to highlight the cyclical reflationary types of trades is that when you're looking into some of these very cyclical oriented sectors, what happens is that the earnings growth potential in these sectors is simply a lot greater than those sectors that don't have this kind of cyclical components. And what it then means when you're going to have 2 consecutive years of global GDP growth beyond anything that I'm likely to see in my career, with Europe growing at 5-6% 2 years consecutively, that just ain't going to happen on any kind of normal recovery year. So I think it means that not only do we have cheap valuation, but we're going to have earnings that are going to be popping way ahead of something which has more kind of a stable earnings generation.